Have you ever wondered how the income tax department catches tax planning tricks that try to reduce tax artificially? Before the government even thinks about using GAAR, the law already contains built-in safeguards called SAAR, specific anti-avoidance rules. Hello everyone, welcome back to our channel. This presentation is brought to you by Synergy Business Advisors Noida, your trusted business mitra providing complete advisory solutions. In today's video, we will understand SAAR in depth, including legal meaning, statutory provisions, practical examples, important Supreme Court rulings, and professional interpretation. What is SAAR? SAAR stands for Specific Anti-Avoidance Rules. These are targeted statutory provisions inserted in tax law to prevent identified tax avoidance practices. SAAR refers to explicit provisions under the tax law that invalidates, modify, or disregard transactions structured primarily to obtain unintended tax benefits. Unlike GAAR, which is a principle-based and discretionary, SAAR is mechanical and automatic. If conditions in the section are satisfied, the rule applies. No subjective interpretation required. Statutory nature of SAAR. One important point assessees often miss is SAAR is not a single section. It is a collection of multiple sections spread across the Income Tax Act, each designed to stop a particular tax avoidance technique. Think of SAAR as a toolkit where each tool targets a specific loophole. Detailed explanation of key SAAR provisions. Let us examine the most important provisions. Section 14A of the Income Tax Act, that is, expenditure relating to exempt income. The provision states that no deduction is allowed for expenditure incurred in relation to income that does not form part of total income. What is the purpose? Taxpayers were claiming expenses while earning tax-free incomes like dividends. Expenses linked to exempt income must be disallowed. Landmark case in this regard, Maxop Investment Limited versus CIT. Supreme Court held that even if shares are held for control and not for earning dividend, Section 14A still applies. So the underlying principle is purpose of investment is irrelevant. Likewise, Section 40A, subsection 2 specifies excessive payments to related parties. The provision states if payment to a related party is excessive or unreasonable compared to fair market value, excess amount is disallowed. Objective: prevent profit shifting to relatives or sister concerns. Example: paying rupees 10 lakhs salary to relative for work worth rupees 2 lakhs. Rupees 8 lakhs disallowed. What is the judicial review? Judicial view. Courts hold that assessing officer must show payment is excessive based on market value. Section 43B, deduction only on actual payment. The provision states that certain expenses allowed when actually paid, not merely accrued. Such payments include GST, PF, bonus, interest to financial institutions. Purpose: stop taxpayers from claiming deductions without making actual payments. Section 50C, property undervaluation. If sale consideration of land building is lower than stamp duty value, stamp value is deemed sale. Stamped value is deemed sale price. What is the purpose? Prevent undervaluation to reduce capital gains. For example, actual sale price is rupees 60 lakhs, stamp value is 90 lakhs, tax will be computed on rupees 90 lakhs. Section 56, subsection 2, clause 10 deals with property received below value. The provision is, if a person receives property for inadequate consideration, difference between fair value and price is taxed as income. What is the objective? Prevents transfer of assets at artificially low price to avoid tax. Likewise, section 94B is there, which talks of interest limitation rule. The provision says interest paid to associated enterprises is restricted to 30% of EBITDA. What is the purpose? Prevent multinational companies from shifting profits through excessive interest payments. Likewise, transfer pricing provisions. International transactions must be at arm's length price. Objective: stops profit shifting to low tax countries. Judicial principles governing SAAR. Indian courts have repeatedly emphasized that where a specific anti-avoidance provision exists, that provision must be applied before invoking general anti-avoidance principles. Hence, what is the final conclusion? The golden rule is, if a transaction falls under a specific anti-avoidance provision, SAAR automatically applies. Intention of taxpayer is irrelevant. That is why SAAR forms the first line of defense in Indian tax law. This is C&IP Praveen Agrawal thanking you for watching. I hope this presentation was helpful for you. Please subscribe to the channel for more such business friendly videos. Thank you.